Well, I've already done one set of practice calculations, and by request, let's do another set. And again, we start with before and after tax worlds. A person maybe is in the 1/4 tax bracket, federal and state maybe, and maybe they earn 12%. What would it be after tax? Well, the government takes 1/4, you keep 3/4, and you get 9%. Watch this next one. A person makes 7% tax-free, and they're in the 20% tax bracket. Well, there's tricky questions and there's trick questions. One's the teacher, one's the real world. I'll let you decide. In this case, it's still 7% because it's tax-free. Let's look at some ratios. There's some biggies here. And ratios allow you to compare unlike firms, at least in terms of size. The biggies are return on equity and return on assets. The return on equity is outside the firm, stockholders, if you will. Return on assets is inside the firm, managers, if you will. Well, the ROE, that's profits over sales, times sales over assets. That's the profit margin times the turnover ratio. And, notice the sales cancel. Now, to get the ROE, we got to multiply times the assets to make the assets cancel and divide by the equity. Turns out assets over equity is not a traditional accounting ratio. So we got to go to the accounting identity. And there's a couple of ways to do that depending on how it's set up. In this first example, we're going to have a firm with $5,000 in assets, $2,000 in debt, thus $3,000 in equity. The debt asset ratio would also, by the way, be 40%, the 2 over the 5. They have sales of $25,000, profits of $750. You know what? We're not going to use those figures. And we have a profit margin of 3%, notice that checks, and a sales asset turnover of 5 times, and that checks. We want the ROA, the ROE. For the ROA, we just multiply the profit margin times the turnover. The sales cancel, leaves profits over assets. That'd be 3% times 5 times, gives us 15%. Now, in this case, because we had a debt-asset ratio, we're going to have to figure the equity. And, let's see. That's, again, $3,000. So it would be assets of 5 over the equity of 3, or 5/3 of 15% gives us 25% for the return on equity. Well, now here's another one in a similar vein, but with a slightly different setup. Here we have a firm that has a debt-equity ratio of 2:4, if you like, 1:2, a profit margin of 6%, and a sales asset turnover ratio of 4. What's the ROE? What's the ROA? Notice here we're just going to directly multiply the profit margin of 6% times the turnover of 4 gives us 24%. Now, let's see, we have a debt-equity ratio, and you know what? Here's a trick. Just add 1 to it. That'll give you the asset-equity multiplier. So we would have, say, 6/4, if you like, 3/2, and, times 24% would give us 36% for the ROE. Let's go to the income statement, and we want to tease out some figures that the accountants do not show, such as cash flow, because, it's cash flow, and EBITDA, that's the earnings before interest, taxes, depreciation, and accrued items. That figure, the EBITDA, tells us what's going on in the front of the store as opposed to the back of the store. The inventory and fixtures don't know whether they're paid for, whether they're purchased, whether they're leased. That figure tells us what's going on, notwithstanding the type of financing. Here, let's say we have a firm has revenue of $300, paid costs of $100, depreciation of $50, interest expense of $30, a tax bracket of, let's say, 1/4, and we want to know the EBIT, earnings before interest and taxes, the net income after tax, the cash flow, and the EBITDA. Well, let's first of all figure out the EBIT that shows in an accounting statement. Well, that's the revenue coming in 300, costs going out 100, plus the depreciation, that's another 50, gives us a net 150. Well, the net income after tax, well, we're going to have to subtract first of all the interest expense and the tax. Now, what was the 150 and the 30? A net 120, tax bracket a quarter, that's another 30. 30, 30, 60 from the 150 gives us 90. Now the cash flow is taking the net income after tax, that's the bottom line figure, adding back the depreciation, maybe some accruals if they exist. In this case we have 90 plus the 50 is 140. Now the EBITDA, you take the EBIT and add back the depreciation, that was 150, 50 is 200. Notice the difference between those two numbers, 140, 200 is 60, and notice that 60 was comprised of 30 for the interest and the other 30 in the tax. Well, there's future value, and that's what you're going to have, let's say at the end of retirement, but we make decisions in the present, so let's look at something called present value. The accountants call a single sum a PVIF, and the annuity, that's a stream of payments, a PVIFA. I'm going to call them a single sum and an annuity. There's also something called a perpetuity, a perpetual annuity. It just goes on forever. And we can use tables, that's fine. In the case of a perpetuity, we will use the reciprocal of the discount rate as a decimal. So let's look at three different variations on a theme. Namely, all of these are $5,000, but the first one's only in year 8, single sum at 6%. The second one is $5,000 every single year, 1 through 8 at 6%, and $5,000 forever at 6%. Well, you could use a calculator, but let's go to the table if you like. That way you make sure the calculator is functioning correctly, or you are. And that'd be, well, 5,000 times 0.627. We get 3,135. Now, the table for the annuity, that's the summation of all those single sums, 6.21, $5,000, we get $31,050. But if we do it forever, watch it, we divide by 0.06 as a decimal for the 6%, and we get 83,000 and some $333. And we can apply these. We're going to look at this example and look at it again and look at it again as we make it a little more sophisticated and realistic. But first, let's say a firm sells $200 a year, has costs of 40. We're going to go across 4 years, and we're going to use a discount rate of 8%. What's the present value? Well, we have 200 minus the 40 gives us 160 a year, and we're going to look at an 8% discount rate, go to the table, we get 529 and some change. But we're going to throw the tax in there a little bit later. Another place present values are relevant is in the valuation of bonds. Major concept bonds go the opposite direction in value from changes in the discount rate, maybe because of society or specifically to the company. Let's see, bonds are typically priced as 100 percentage points of face value. We want to know the value of a bond that pays 6% a year, but we'll do annual here. They're actually twice a year, but it's just almost the same answer. And matures in 7 years, and we want a yield of 5% because it pays more than what we want, should trade at a premium. Let's see, face value is 100. The interest payment would be 6 points, and so that'd be an annuity times the 5.786. Face value is a single sum, 0.711. Total value, 105 and some change. As we would expect, trading at a slight premium. Now let's revisit that problem we looked at before. This time we're going to look at it after tax. Again, $200 a year is coming in for 4 years. Costs are $40 going out for the 4 years. But now we have a tax bracket of 1/4, and that 8% for the borrowing, well, that was pre-tax. What's the present value? Well, again, the 200 minus the 40 is 160, but now after tax, we keep the 3/4, so that's 120 a year. And we're going to use a 6% discount rate. That's also after tax. We pay the net 3/4, and so we're going to use 120, 6% for 4 years, a factor of 3.465, and we get 415 and some change. We looked at bonds. Let's look at stocks. The valuation for stocks sometimes just stop at the immediate dividends in the near future, but sometimes those dividends grow at a constant growth rate, let's say G, and turns out that would be either next year's dividend divided by, say, the discount rate K minus the G growth rate, or if you're looking at the current dividend, you have to increase it to the next year dividend. Here's the first one. Stock will pay next year a dividend of $3, grows at 7%, discount rate's 13%. We plug and chug. We get $3 divided by the 13 minus the 7. Notice it's a decimal, and we get $50. How about the stock just paid a dividend of, say, $4 a share, grows at 5%, and should be discounted at 10%. Well, we have to adjust that dividend to next year, so we have $4.20 plus the 5% growth, dividing by the difference of 10 and 5%, we get $84. Our next topic is, well, it's not hard, it's just confusing. And it's kind of like the packing problem. If you have enough money to do all projects, you accept any that have a positive net present value. But maybe if you have to choose between projects that are the same but financed differently, that would be mutually exclusive, can't do both, you choose the one with the higher NPV. What if you have a constrained budget? You don't have enough. Well, in that case, you would choose the one with the highest internal rate of return. Well, here we got 3 projects, A, B, C, net present values 27, 12, and 33, internal rates of return of 6, 3, and 1. And let's say these are all the same flower shop, financed different ways. Well, you have more than enough money to do 2, but you can only do 1. So you choose the highest NPV, and that happens to be here C, with an NPV of 33. What if these are 3 different firms? Auto shop, flower shop, insurance company, and you have 200. You can only do 2 of the 3. You would choose the highest internal rates of return, which here would be A and B. Well, remember that problem we went to once and then we did it again after tax? Here's the full-blown version. What we're going to do now is look at lease versus purchase. In the case of a purchase, you get savings on the tax from the write-off of the depreciation. That's plus the tax times the depreciation. And if there's salvage value, you add that in too, minus the initial outlay. And that's in contrast to a lease. Notice they're mutually exclusive, can't do both. In the case of a lease, it's just a negative payment, tax deductible. Have to adjust for that. One of the tricks on the lease, though, is they're usually paid up front, so we have to adjust that to a beginning of the period payment. And we're going to use an after-tax discount rate. And if it's predominantly from a loan, well, make that after tax. But you may say on a lease there's no loan. Well, consider it the opportunity cost of not taking the loan. Well, again, firm earns $200 a year, cost of $40, 4 years, tax bracket is 1/4, and the pre-tax borrowing rate is 8%. Everything's the same. Although now we have an initial cost of a purchase of $120 and depreciation of $30 a year. Let's make this straight line and make it easy, and no salvage value. The lease, on the other hand, is $80 per year with beginning of the year payments. First thing we're going to do is look at the revenue side, which we've actually already done, and we're going to net those out against the purchase and the lease. Again, revenue $200 minus the $40 after tax. We got $120 a year, discounted at 6%. Same figure we had before, the $415 and some change. What's new here is the purchase and the lease. Let's do the purchase first. First of all, there's an outgo to buy it times 0 of minus $120. Then we're going to get the tax savings on the depreciation, shielding us from the tax. The tax bracket's 1/4, so we're going to save 1/4 of that $30. And that's across 4 years. We're going to use that same factor, 3.465. No salvage value. So we net those out, so the purchase costs us minus 94. Offsetting the revenue gives us a net present value of the business with a purchase of 321.79. In contrast to the lease is minus 80. That's after tax, so it's minus 60. And, well, let's take that factor we had before, but make it 1 year sooner, which makes it 6% larger, present value. And there's a little trick here, we'll show it to you. So that beats minus 60 times 3.673. The trick is, how about if we went to 1 year earlier, beginning the period, added the number 1, because the very first period is times 0, present value, that's $1, and we get, guess what, the same factor, 3.673. Times the minus 60 is minus 220. Well, that's the lease. Make a net present value against the income of the 415, gives us a net present value for the lease of 195. Well, it turns out that maybe you might prefer the purchase. Trouble is the purchase has some risks. Interest rate risk, business risk, a style risk. You might actually go for the lease because it's less risky. Up until now, we've been giving you the discount rate, and it many times comes from something called the capital asset pricing model. There it is up on the top. The risk-free return, say Treasury bills, times something called the beta, happens to be the covariance divided by the variance, times something called the market premium. That's the return to the market minus the risk-free. Let's say we had two securities. A had a beta of 3/4, returned 11. B had a beta of 1 1/4 and returned 13. The risk-free is 4%. Return to the market is 12. That means the market premium, the difference of the two, is 8 percentage points. What should they be, and which one should be accepted or rejected? In the case of A, we take 3/4 of the premium is 8, plus the 4 gives us 10, but offered us 11, we'd accept it. And because it's below the market, slang term for these is call them cash cows. In the case of B, we had 1 1/4 of the premium of 8, plus the risk-free gives us 14%, but it only offered us 13%. We would reject that one. And the CAPM is where we get the Ks for those discount rates. Well, it's time now for a WACC attack, the weighted average cost of capital. And sometimes you don't use just debt, but you may use, say, stock, preferred stock. We'll omit that here for financing, and you might want to know what its cost is. And they would be weighted components, add to 100%. That means if you're using just stock and debt, that the weight in equity would be 1 minus the weight in debt. Now, the cost of debt is the interest expense on the bonds, let's say, after tax. And we could take that previous stock valuation model, solve for the K, or maybe we could just capital asset pricing model. And, well, that'd be the dividend over the price plus the growth rate. You can do these either as decimals or percentage. Let's say we have a firm that has $3,000 in debt, $5,000 in equity. Guess what that adds to? $8,000. So our weights are 3/8 and 5/8. We have 8% in debt, a quarter tax rate. That means it's now 6% on debt. We have a $2 stock dividend on $50. That's 4%. And it grows at 6%. Let's add those together. We get 10%. Well, 3/8 of the 6 plus 5/8 of the 10, now in decimals as converted to percentages, we get 10 3/4 percentage points for the weighted average cost of capital. Here's a variation on a theme. We have a firm with a debt-asset ratio of some 66%. Let's make it a 2/3. Tax rate of 33%. We'll make that 1/3. Interest rate is 8% on the debt. Guess what? That's going to make that 6% after tax. And the stock pays $6 on a price of 100. That's 6%. And no growth, still 6%. What's the weighted average cost of capital? Well, we got 2/3 in the debt times 6% after tax. And then we have the remainder of 1/3 times 6% for the stock. And, well, 2/3 of a 6 and 1/3 of a 6, of course, adds to 6%. Time for our new topic. The economic order quantity tells you how much you should withdraw, store, and even for you just-in-timers, it tells you how frequently your just-in-time deliveries should be. Mnemonic trick here is King Tut overseas, 2 times the usage times the transaction cost divided by the carrying cost, could be in units or percent, all taken as a square root. It optimizes the equation of the total costs, which is 1/2 the inventory times its carrying cost on average, and the number of orders, well, that's the usage divided by the quantity times their transaction costs. Let's do an example. Firm uses 10 grand a month, watch it, 24 per order is the cost for the transactions, 9% is the interest rate. What should it withdraw? How often? And what's the total cost? Well, let's see, we have 2 times the 10 grand, times the 12 times a month per year, $24 divided by 9% is a decimal, square root is 8 grand. Now, how often should you do these? Well, you have 8 grand is the optimal quantity, and you're consuming, 10 times 12 per year, divide that through, you get 15 orders per year. A little more than, say, once every month. And, well, the total cost will be the half of the average of that inventory, 8 divided by 2, 9%, plus you had 15 orders a year, cost of each order is $24, adds up to $720. Here's a trick of the trade. Notice if you're at the optimum, those 2 component figures should be equal, and notice here they were. Time for a little break even, not that hard at all, is, it's fixed cost divided by the profit per unit, that's price minus the variable cost. And you know what? That's just taking the equation for the profit of the firm, revenue minus cost, and solving for the quantity. Let's say we had fixed costs of 12 grand, labor costs are $24 per hour, and make 3 units per hour, and raw material costs are $4. We're going to check out 2 prices of $15 and $18 a unit. What's the break even? And by the way, also, let's figure that in dollars. Well, the variable cost is that 24, but we make 3, so that's actually $8 per unit, plus 4 makes 12. For $15 as a price, we're going to have a profit of $3 a unit, is 4,000 units, thus $60,000. On the other hand, for an $18 price, we're going to divide the 12 grand fixed by 18 minus the 12 is 6. We get 2,000 units, but times $18 a unit, we would have a break-even revenue of $36,000. This is just a feasibility study. You got to check with the marketeers to see if this thing's going to really fly. Our final topic is foreign exchange, and if you think about it and or have traveled, one exchange rate from one country to another is the reciprocal when viewed the other direction. They can change in the future, and here's a tip. It will go the opposite direction from the differential in interest rates if viewed from the same country. There's something called a purchasing power parity theorem. Think of it as a Big Mac index, but you know what? Labor rates, shipping costs, doesn't work too well. We're going to call this the interest rate parity theorem, where if you open 2 accounts, whatever is the 4th variable should adjust to make you break even. Usually it's the future exchange rate. Here's a pretty straightforward example. U.S. return is 12% and the U.K. is 4%. The British pound's currently worth $1.50 American. What would be the 90-day future exchange rate? 90 days is about a quarter of a year. So we're going to take a quarter of that 12 in the U.S. making it 3, and the quarter of the 4 in the U.K. making it 1. We're going to get 3% on $1.50 in the U.S., 1.545, and we're going to get 1% in the U.K. on a pound, giving us 1.01 pounds. The ratio, 1.5297. That's almost 2% more, which is what you'd expect. In this tricky example, here's a trick example. Remember I asked you that before. We have a Swiss franc is currently 80 cents American. The 90-day future exchange rate is 0.816 US dollars per French franc. The return in the United States is 8%. What should it be in Switzerland? Well, let's see. The U.S. account of 80 cents earns a quarter of that 8, so that's 2%, gives us 0.816. But that's the same as the exchange rate. We have to divide to make the dollars cancel, make the answer in francs, and guess what? Well, the only thing that makes 1 equal 1 is 0. And of course, you'd have to adjust for the quarter of time, meaning the 2% return was totally in the form of Swiss francs, and Dr. C invests.